Hey, what's going on, everyone? Hope y'all are doing well. Welcome back to another Aerial Effects episode. And in this video, I will be talking about the cycle of a Forex trader. Now, this is more along the lines of a psychology video, but it will definitely be an eye-opener for those struggling to make consistent profits. So definitely sit back and take good notes. This is going to be something that you're not going to want to miss out on. It's really important that you have a clear understanding of the cycle in which you are trading, not only in the market cycle, but the psychological cycle that probably many of you go through. And it's very interesting how the market actually moves. The market moves based upon the psychology of traders. It's not just random movements in the market, it's based upon obviously volume and liquidity. But at the same time, these moves will be seen in the same way of how a retail trader looks at the markets and how their emotions are involved in it. So in order to escape the inconsistencies that you're seeing within your trading and be able to take your trading to a whole new level, you're really going to want to understand the ins and outs of your own psychology. Now, I'm going to break down your psychology today. I'm going to try to take a deep dive into the way that you think. And if you don't think this way, then maybe you're already on the right track. But hopefully, some of you can resonate with this, learn from it, and then move forward and become a better trader because of it. So yeah, here at Aerial Effects, we strive to be the mentors we wish we had when we first started trading. And I think this will definitely help you. This is something that I wished I had learned right off the bat. So hopefully if you are a beginner or more of a seasoned veteran in this market, you will still take some value from it. And let's just get right into it. Let's explain what the cycle of a Forex trader is and sort of what it looks like. So this is just a basic understanding of how many traders attempt to find strategies, trade them, and then move along. This is something that is prevalent, and the reason why 95 to 99% of traders in this industry lose and quit is because they are thinking that it's the strategy that's bad or the strategy that's wrong, when in all reality, it's just the trader who's not putting in enough time to make it work. If the market were that easy to trade, everyone would be rich. Let's be real, okay? So we have to understand that this is a very lucrative, comprehensive market that takes an exquisite set of skills in order to master. Now, it is not impossible to become proficient in this industry, but it takes the exact opposite of what everyone else is doing. Observe the masses and do the opposite. That is what we say here. So many people find a strategy, will learn something new, will find something on YouTube, they'll take a course, whatever. They'll find a strategy, they'll create a plan for that strategy, and then they'll start to trade it immediately. They're going to look at the market every single day and try to trade it based upon what they've learned in either the course, a book, a video, an article, whatever you may have you, they will try to trade it. And I say this to every one of my clients, you will fail initially. It's how the process works. We cannot expect to automatically learn something new and not initially fail at it. Ask any professional athlete, ask any professional entrepreneur, ask any millionaire, billionaire who is actually a successful part of society, whether they have failed. Warren Buffett once said, I will not invest in any company or anyone who has not failed at least twice. Why is failure so important? Failure is so important because it teaches you so many learning lessons. If you don't fail, then you don't know what failure is like and you don't know how to respond from that failure and move through adversity as it hits you. Okay? Because if everything is going well for you, what happens when you fail? Are you going to get right back up and continue? Are you going to know how to handle the adversity? If you don't, you're going to even fail further and further and further, and you're just going to keep going down and digging yourself into a deeper hole here. So failure is definitely a part of the process here. But how the retail traders thinks is that they think that they can start trading immediately following a video they watched or a concept they learned or a course they took and expect to make money and immediately expect to have initial results. And that's just not the case. Learning everything like riding a bike takes time. Someone may teach you exactly how to do it, show you exactly how to do it, But until you do it yourself, you cannot be good at it. And what happens when you finally do it yourself? You fall, just like everyone does. No one has first ridden a bike and has become good at it immediately. It takes falling, it takes learning, it takes failure to then finally be up on the bike and not fall and keep going. That's what it takes. But retail traders want that instant gratification and want to make money instantly and not take the time to fail and learn from it and understand that it's not the strategy that's wrong. It's the trader that's not putting in enough effort and not having enough patience in order to make the strategy work for them. So they create a plan and trade it. They suffer some losses and they think it's the strategy that's bad, so they dump the strategy. They go to the next strategy, and the whole cycle repeats over and over and over again. Now, here at Aerial Effects, you already know that we trade institutional concepts. We already know that it's the only strategy that actually works in the market because it's the most applicable, logical strategy that is based upon the actual real market movements. Who's moving the market? The big institutions. It's not us. So we have to understand where they're getting to the market, and that's exactly what we teach. That's why we're so successful. Now, I'm not saying you can't be successful with other strategies, but even if you take our strategy or anyone else's strategy and lose with it, it doesn't mean the strategy is wrong. It's just you are not doing enough to make it work for you or not getting enough help that you need to become successful. You're thinking more from an instant gratification standpoint and not from a learning experience standpoint. The fact of the matter is, guys, everything good in life does not come easy and it does take time, especially in Forex. It will take you 6, 12, 18, 24 months, sometimes even more to become good at this. So the cycle continues. You find a strategy, you create a plan, you trade it, you suffer some losses initially, you give up, and you dump the strategy. You find a strategy again, create the plan, trade it, suffer losses, dump the strategy. And the cycle continues and continues and continues. And the problem that you're facing is that you're continuously moving around from group to group, from strategy to strategy, trying to find the holy grail. In all reality, there is no holy grail strategy. It's just you being impatient enough or not being patient enough to actually learn what is being taught in front of you. What you really need to be focusing on is finding someone who has the knowledge, who has the experience, and taking what they are teaching you and applying it every day and understanding that you're not going to get it right away. It takes time. But if you work on it, you're going to be successful later on because it's worked for someone before. So if it's working for someone or a group of people, then there should be no reason why it can't work for you. All right, so that is the whole cycle, then finding a strategy and ultimately dumping it to just find another one again. All right. Next, the cycle of a trader. Now, what does this look like? If you get rid of all of the words, all of the lines or the red lines and all of the numbers, what does it look like? It looks like a chart, doesn't it? The blue line pushing up, pushing down, pushing up. Now, what's really interesting about this, and this is something that no one really teaches anyone, is that the movements of the market are exactly, it's like a picture representation of you thinking. Imagine that. Imagine trying to put your thoughts. Imagine if you're playing a game and someone tells you to draw a thought. What is a thought? You can't draw a thought, right? Because it's not physical. But in all reality, when it comes down to trading, this is the actual definition of your thoughts on a day-to-day basis. What are you thinking? What's going through your mind? Your psychology. This is the actual picture of what it looks like. So what I'm going to be doing here is going through each and every one, and I'm going to explain how it works, why people think the way they do here, and how you cannot think this way so that we can shift your understanding to a more professional mindset so you do not get caught up in the retail trap that everyone goes through in their psychology. So first and foremost, what does everyone think? They always want to get in at the best time, but they're always unsure, right? So number one, the price is going up, let's watch the market. So they're hesitant, right? They're hesitant. They see that price is pushing up, but they don't want to get in too soon because they need more confirmation, right? They're trying to make it work in their own minds that it's okay to buy. They're not taking it from a factual standpoint, from a numbers statistical standpoint, what is actually being shown on the chart. They are listening to the voice in the back of their head saying, oh, if I just get a little more confluence maybe, then I'll make the decision to buy. when in all reality, they're not taking it from the actual factual standpoint of what the market's showing them to get in way before they're actually getting in. Number two, the trend is holding. I'll buy at the next consolidation. This is really what, you know, proves that retail traders are so much different than institutional traders is because when they say, I'll buy at the next consolidation, what are you telling me? You're essentially telling me, okay, I want to buy, but I'm not quite ready yet. I want to see more proof. I want to see more consolidation so I can catch the next move. So you're saying that if I don't want to get in quite yet because I'm not sure it's actually going to go long. I want to wait for more confirmation. So in case it goes short, I'm not going to get in long here so I don't potentially miss out on a loss or I, get in on a loss by accident. So what that is telling me is that you are unsure as to where the direction of the market is actually going and the overall objective in which the market is pushing into. So you're not only getting in at the wrong time, but you're saying, okay, I am not confident in this setup. I want to wait for more confirmation before getting in case it does go short. Right? So you're already right there not understanding what in the world you're doing approaching the markets. Number three, damn, I missed the consolidation, but if I wait any longer, I won't profit from the trend. Let's buy. You're getting in at a premium price. Price has already made its move. You're already starting to push up. Now you're getting in because now you see all of your quote unquote confluences for the trade. This is where many traders go wrong. They have the fear of missing out. They don't want to miss out on the move. They have to be able to get in and try to make a profit, but they get in at the wrong time. So they get in late. It's always at a premium. And that's when the market starts to move against them because they know exactly where everyone is getting in. The institutions have the order book. They know where all the volume rests. They know where all the positions are held. They know where all the stop losses are. Guys, it's no coincidence that you may be losing a majority of your trades or not profitable. It's because you're doing the same thing that everyone else is taught to do. This is how the psychology of a trader is, and this is what it looks like. So you get in at the worst time because you don't want to miss the move. However, you needed a little more confirmation in order to pull the trigger because you're not thinking realistically. You're thinking, in terms of your own mind. You're not looking at it from a factual standpoint. So now you get in, and by then it's already overextended, and now price starts to pull back. So I'm not sure why it doesn't say number 4, but number 5, I'll use this correction to increase my position. Now you're thinking, okay, well, it's gone in a little bit of profit, starting to pull back. Well, I can't be wrong here. So I must, it must just be pulling back for another move to the upside. Let's add my position or add another position in when price pulls back. Number 6, brilliant. At this price, let's double it. Great. You've had the pullback, right? You think, okay, well, now we're, pulling back a lot. Let's get back in the market at a discounted price, okay? Because we're getting a better price. Let's buy. Let's double my position. Let's over leverage. I can't be wrong on this trade. I'm going to win. I'm going to win. That is what sets you up for failure. Number 7, ouch. As soon as it goes back up, I'm selling it out. So you're saying that, oh, I'm experiencing a lot of drawdown. I want to get out. This is uncomfortable. I don't like this. When it gets back up to break even, I'm just going to close my position. That's not a realistic way of thinking about trading, guys, at all. Number 8, I don't believe it. It's down to 8.25. It's hit its absolute bottom. You thinking, oh, it can't go down any further than this. It's already selling off so much. There's no way it can go down. It has to go up eventually. Number 9, okay, let's wait for it to recover. Otherwise, this will have to be a really long-term investment. So you're saying, okay, I'm going to stick it out. I'm not going to sell because if I do, I am going to lose a lot. Well, first and foremost, guys, sometimes it's okay to cut your losses. First and foremost, you really should have a stop loss in the first place. But in all reality, you need to understand when to cut your losses. Professional traders cut losses when it's appropriate to really over time not lose more than they possibly could, right? So that's why it's always important to cut losses if you're ever experiencing this type of move. But retail traders, they don't want to lose. The psychology, they don't want to see their whole account size go down by however X percent, right? Because I'm sure they're over leveraging in the first place. They want that long-term investment. They want to stick it out. They want to hold it until it finally reverses. Number 10, what is the SEC doing? SEC is just essentially the overseer of financial markets to make sure everything is sound and traders are being protected. So what is the SEC doing? Essentially, what this is saying is there is no way that price is falling this much. Something must be going wrong. Something may be fraudulent or manipulative. There's no way that it can actually go down this much. In all reality, it can. If the market wants to do it, it can do it. That's why we have these SEC regulators in place to prevent this from happening in the first place. So if you see any of these moves, it's a realistic move, guys. Sometimes you have these huge pushes, right? And if you're on the other side of the market, you're probably thinking, oh, it has to go up eventually. What's going on? There must be some sort of you know, bad fraudulent activity going on. Finally, number 11, enough. I'm selling out and staying out. I quit. I'm done. I'm getting out of the market. Fine, whatever. I lose. You take your money, or you lose your money, and you move on. Okay. Now you've sold at the very bottom. You've bought at the very top, and you sold at the bottom. So you see how psychology is starting to play its part here. And I'm not saying that, oh, at the moment in time that you want to sell, oh, it's probably going to finally go long. That's not what it's saying. This graph here, it may not go long. What if it just continues to sell off? Then you're really screwing yourself. But the psychology says that, at some point you are going to say, okay, I'm done. I can't take anymore. I have to just get out. This is, really, really, really bad for my account. I don't know where number 12 is, but number 13, starting to pull back. It's going to tank anyway, right? Starting to pull back. You're like, it's just going to keep going short anyways, oh, well, it's going to tank. This is what's going to happen. I'm good. I got out. 14, I don't know where it is. 15 says, you what? Now it's starting to push in the correct direction. They're like, there's no way. Like, what's going on? Number 16, what the hell? Like, what's going on? I sold at the wrong time. Now it's starting to push up. There's no way that this is possible. It has to go back down. And they're getting it in the back of their minds that they're still right. They're trying to come up with a reason why the reason for what they did is still correct. Why did they get out at where they got out, which is number 11? They're trying to create excuses for why they got out at that point to say, okay, when price starts pushing back up higher, oh, it has to just fall down again. I mean, it's already pushed down so much. I got out of the trade. It's going to continue. It's just having a little bit of a retracement. That's what they think. Number 17, more crazies who are going to get taken to the cleaners, meaning anyone who's trying to buy right now, it's just going to sell off. Whoever's getting in right now is stupid. It's just going to sell off again. Now the opposite starts to set in. Number 18, this is it. I knew this was going to happen all along. When price finally starts to rise again, you finally switch your bias and you're like, I knew it was going to happen. I knew we were going long. It's that you don't want to sound wrong. You don't want to be, you want to deny all other accusations, right? Because you knew it before, right? For number 3, you got in, let's buy. Oh, I knew it was going long. It just didn't go long when I wanted it to. Well, right. Number 19, Drat, I'll buy in again. It's cheaper than last time anyhow. So now he's experiencing FOMO again. Now he gets back into the market and the cycle repeats all over again. Okay. You get in at a premium, you buy at a premium, you sell at a discount, you're just going to keep blowing your account and losing money. Okay. So this is the cycle of a trader, how psychology kind of comes into it, what people are thinking at different levels. And guys, it's not going to be the same every single time, but over the course of, a year, 5 years, 10 years time, and you see the charts and you see, millions of traders doing the same exact thing. Overall, the average is this is how people think overall. So how do we get out of this mindset to not only not think about this, but to have the opposite mindset? First, we have to not only figure out what's going on and what they're thinking during the different stages of the market cycle, but at the same time, having a clear trading plan and sticking to it. Going back to what we talked about before, finding a strategy, create a plan, trade it, suffer some losses, dump the strategy. You're not fine-tuning what you're doing. You're just trying to find the holy grail, but there's no such thing as the holy grail. That is why so many people quit trading, because they don't have the patience and they think it's easy and they want to make money instantly and they don't have what it takes to suffer through losses and learn from their mistakes. The people who do that are the ones who come up on top, the ones who can persevere. They're the ones who are wealthy. They're the ones who drive Lamborghinis. They're the ones who have 7-figure trading accounts. It's because they've been through all this. So I want to tell you, especially for someone like me and my business partners here at Aerial Effects, we were in the same spot you were. We did the same thing. We hopped around from group to group. We went from strategy to strategy. We failed so many times that I wanted to quit. I was broke, absolutely broke at one point. But I was like, you know what? If I quit, the best thing that's going to happen is nothing, right? That's the best possible thing. Nothing will happen. I will stay in the same exact spot. So I couldn't quit physically. I had to keep going. And eventually, working towards it day after day, week after week, month after month, year after year, I'm finally consistent, profitable, very, very well-rounded and well-versed smart money trader, which is why I am where I am today. And I'm so blessed to be able to say that. But it takes someone like that, and it takes going through losses, learning from them, and never giving up for you to actually be successful. This is a process. This takes a long time. Okay, this is not a get rich quick thing. So let's apply this to the real markets now. Okay, so here, number one, huge breakout to the upside. Let's keep an eye on this one. So kind of going back to number one here. The price is going up. Let's watch the market. Number two here, the bullish run is continuing. I'll buy upon the next consolidation, right? That's number two here. The trend is holding. I'll buy at the next consolidation. Okay. So they're trying to figure out a way to get into the market, but they're not really ready yet because their brain isn't telling them to get in because they don't know what they're doing. They're just trying to listen to that voice in the back of their head saying, oh, I'm not ready yet. I'll just wait a little while longer, just a little while longer. It's not how you should approach the market. Number three, the retail entry. The consolidation occurs. You're looking for a little bit of a pullback to get in off the next leg. Number three, darn, I missed the consolidation, but if I wait any longer, I won't profit from this trend. Let's buy it. Number four, I'm guessing is, woohoo, I knew it. You're in profit. You're feeling euphoric. You're feeling good. And then number five sets in, great. A pullback, I'll add to my position, right? It's just pulling back. It's going to continue to go along in my direction. I got the direction right. My trade is going really well. That's just like number five here. I used the correction to increase my position. Number six, time to buy again. Let's over leverage. There's no way I'm wrong. Of course I was right the first time. So it keeps pulling back. You're like, okay, let me add more to my position. I must be getting it at a better price before it goes long again. Same thing here, number six. Brilliant. At this price, let's double it. Number seven. Not to worry. I'll get out when it pulls back to break even. So maybe I wasn't right. Maybe it'll, continue to go short, but maybe it won't. Let's see. If it pulls back, I'm just going to get out because I don't want to suffer any potential losses. That's exactly what it's number seven. Ouch. As soon as it goes back up, I'm selling out. Number eight. I don't believe it. Why does it keep falling? It's like you don't understand. It's like, why does it keep going in my opposite direction? Because you have tunnel vision. You're thinking that your buy that you originally had is the only thing possible that the market can do, and that because the market's selling off, the market must be wrong because you're not wrong, right? Because you're not wrong, the market must be wrong. So why is it selling off? Why does this happen? There must be something wrong here. Same with number eight. I don't believe it. It's down to 8.25. It's hit its absolute bottom. You're in self-denial right now. Okay, so number 9, 10, 11, and 12. So it says, okay, let's wait for it to recover. Otherwise, it'll be a long-term investment. What is the SEC doing? All right, enough. I'm selling out, staying out. Same thing as, okay, that's it. I'm selling. So you get out at the worst possible price. You get out at a discount, but you bought at a premium, so you lost money. Number 13, it's going to tank anyway. It starts to pull back, right? Price is starting to pull back now. You're like, oh, it's going to tank again soon, right? Number 14 and 15 continues to push to the upside. No way. There's no way that price is actually going to go long. It has to fall eventually. So that's 14 and 15 here. It says, you what? Like, there's no way this is actually happening. Number 16 and 17. What the hell? It pulled back and continued to go long. How is it not going short? I thought I got out at the bottom. It should really continue short because that's what the market's doing. It's going short. Number 17, more crazies who are going to be taken to the cleaners, right? They think, oh, I was right the whole time. There's these suckers who are getting in now. They're going to lose because it's about to tank again, right? Number 18, I knew this was going to happen the whole time. Time to buy again, right? Now they're like, oh, my initial direction, my initial trade was right. I knew it. I knew it was going long. That's what 18 says. That is it. I knew this was going to happen all along. Then 19's like, drat, I'll buy it again. It's cheaper than last time anyhow. And number 19's like, yep, I told you so. I knew it was going to go long. And then guess what happens right after that? Starts to sell off, and the process repeats over and over and over again. So guys, this is how many people are thinking about trading. Whether you realize it or not, it may not be what you're thinking verbatim. However, this is how you are approaching the markets from a retail mindset standpoint. And guys, I'm not saying that you in particular is thinking this, only you know that yourself. You just have to ask the question, are you profitable? Are you consistent? Are you a master trader? And if the answer is no, then this is probably in some degree what you're thinking on a day-to-day basis while you're looking at trades. If you are inconsistent, if you are not making money in some way, shape, or form, whether you recognize it or not, this psychological chart here in the way the market actually moves is based upon your subconscious thinking. We have to get you out of that subconscious thinking so that you're not thinking of this exact same thing. And this is exactly why Forex trading and retail trading became prevalent back in, I think, the early 90s or something. It was originally just the interbank market. It was originally only open to big time fish, big time institutions and banks. They opened it up to the public. Why? Because it's a playground for these big fish. They knew that they could take all the retail money. Retail traders are stupid. They're idiots. They don't know what they're doing. As a big bank, you can manipulate price all you want and take all the retail trader stops. You go through an emotional and psychological roller coaster with them, they're going to end up blowing their account over and over and over. You know how many billions and billions of dollars these institutions have made off of you? A lot. It's because it's money at the end of the day, which is why it was made public. And that's exactly why the market moves like this. It's a psychological roller coaster. You can see how, it just looks like with that blue line, it's just a push up and a push down, a push back up. But it's the actual, it's a drawing of your thought process. Think about drawing something that's not physical. You can't really fathom it, right? Like drawing a thought. You can't really draw a thought. What is the thought? Well, that's exactly what it is. The market is an exact representation of your thoughts, of how the retail mindset works. The psychology and emotions that drive the retail trader, that's exactly what the market looks like. It's an actual representation of your emotional roller coaster, if you will. Because at the end of the day, that's true because people are getting in at different times, like the retail entry for number 3. They sweep liquidity, go in the opposite direction. It's all about market manipulation, but from a screwing over the retail traders. So they do it in a way that the institutions continue to make money over and over and over again, but then you continue to lose on a day-to-day basis. Now, in order to properly get out of that mindset, I've also drawn up a chart as to how we can look at this exact same chart but have a different mindset towards it. Okay, perfect. Number 1, breakout. Let's wait for the retracement getting back into discount. We're overall bullish. We saw the BOS. Okay, we've made that higher high formation. Let's be patient. Let's wait until it starts to pull back into our original area of interest where we initially broke out, whether that be that demand level or that imbalance that formed. Number 2, it's still rising. Oh well, we will wait. We'll sit and wait patiently. Okay, we will sit on our hands because there is no current setup. We cannot be attracted to FOMO. We cannot try to get in thinking, oh, it's going to continue to go up. I might as well get in now. If it doesn't, then oh well, we move on to the next trade. If it does, great. Then I'm getting in at my original discounted price where the highest probability setup is. Because if you're going based off of FOMO, you're going based off of your mind and not by facts. And the facts will always trump how you think. Number 3, discount at last. I'm glad I waited. So the institutional trader is glad he waited until discount comes into play. And we pull back into our 50% of the imbalance to retest prior market structure where we initially broke out from right before that demand level. And we get in at 83923. Time to buy, 50% imbalance. And boom, you get a wick entry at a much better price than the retail trader would. Then the retail trader would probably in and around number 2, in and around this level here where they originally bought it because they had FOMO. But now they're not stuck in this position so that when they're in drawdown, their emotions are going crazy and now they're selling when they get out here. And instead, the institutional trader comes in and understands, okay, we have liquidity that was built up from retail traders. Now let's get in off of a discount in our original level. Because if it kept going long and long, well, there's other pairs to trade. There's always another day. We move on to the next setup. That's how you have to think. So number 5, stop to break even and takes partial profits. You take partials, move stop to break even usually when we break a prior structure point to the upside, because then this lower structure point for number 4 would be that where you would move stop to break even there. We probably won't come below that level. So we've made some money. Number 6, if it falls, I've still made money and my position is protected. Now I'm not having to worry about the whole emotional roller coaster that comes with trading. We pull all the way back down into discount again. We recognize that blue box is a demand level. Prior market structure, we're making higher highs, higher lows. We're being patient and waiting for price to come back into discount. Number 7, time to buy again. Price is at a discount and has come into a demand level. Gives me a high probable chance that this will succeed. And then obviously number 8, woohoo, I love the correct way of trading, and you're in profit there. So that is the way in which we approach the markets. Now, it's not going to be the same every time, guys. Obviously, every single trade is going to be different. But if you have the understanding of the strategy at hand and the psychological type of movements in the market, the way that the market produces psychological events, how people are thinking upon every single movement. That's why retail traders lose. I mean, think about it. We have this level here, these two lows. I don't know if you can see my cursor, but between 1 and 3, there are equal lows in here. Okay. Within those equal lows, people are buying, right? They're buying off support. That's what they're told to do. So when price comes back down, we sweep the liquidity. We have to be patient. Okay. That's what separates retail. Their psychology saying, oh, I have to buy at this price point, keeps rejecting, I got to get in. But then the institutional trader is like, okay, I understand there's liquidity resting below because I see that price is rejecting. People must be buying there. Now there's liquidity resting below. Now I have to wait for that liquidity to be taken. And then usually a reversal is imminent after that. And for more confluence, we have the imbalance at that 50% and the break of structure to retest prior market structure, continuing with the higher time frame trend. So guys, I know I've been through a lot. Rewatch this video as I was talking very fast, but this is how all of these retail traders and people who are consistently losing money, even if you're not a retail trader, even if you are an institutional trader, right? If you're a smart money trader, if you're not consistent, you're probably subconsciously still thinking about stuff like this. This is how your brain is working at this current time. So there is a way out of it, but it's no easy process. However, we want to be able to produce as easy of a process as possible through our program, in which we will take you through our 3-course series in which we have developed over the last 3 and 4 years that we started trading, and then coupled that with our one-on-one mentorship to make sure you are reinforced in these areas. So taking that education, making that the foundation, and then working with you to continuously grow your skills. So guys, if you're interested in something like that and learning how to really take the opposite side of where all the retail traders are getting in and have that institutional mindset, feel free to head over to our website, www.aerialfxtrading.com. Book a free consultation with one of our traders just to see if we're the right fit for you. We may not be the right fit, and that's why we want to talk to you beforehand to make sure you are. And if you are, we would love to work with you. And if not, we'll wish you nothing but the best, but maybe we're not the right fit. So just in case, you spend any money on your education, we want to make sure that this is actually going to help you and benefit you based upon your current financial goals and your overall trading lifestyle. But I highly recommend even you just speak with us. We will provide you with our trading plan for free just for booking a call. So thank you guys so much. I hope you guys enjoyed this video and took a lot of value from it. As always, if you have any questions, please feel free to let us know. I'll be happy to help you out as much as I can. So stay tuned for the next video and have a great rest of your day. Thanks.